So let's talk about something you probably hear about all the time, the RBI's interest rate decisions. We hear the news, but what does it all really mean? Why should you care? Well, today, we're going to decode it all.
Right? You see the headlines pop up, you see the stock market go a little crazy, and then maybe you notice your loan EMI has changed. But what's the real logic behind it? Is it about inflation? The value of the rupee? Something else entirely? We're going to break down exactly what's going on.
Okay, so to get any of this, we first have to wrap our heads around one central concept, the repo rate. This is the key to everything.
Think of it like this. The RBI is the main bank for all the other banks in the country. Your bank, my bank, they all borrow from the RBI sometimes. The repo rate is simply the interest rate they have to pay on those loans. It's basically the foundational cost of money in the entire system.
And honestly, it all boils down to this simple idea. If it costs more for your bank to borrow money from the RBI, well, they're going to charge you more for your loans. But if it costs them less, they can pass those savings on to you. It's a ripple effect. And once you get that, the rest starts to make a lot of sense.
All right, let's start with the first big scenario. The news breaks that the RBI has hiked rates. What's actually happening behind the scenes? Why would they deliberately make borrowing more expensive for all of us?
The number one reason, the one you hear about most, is to fight inflation. When the prices of everything from vegetables to fuel are rising way too fast, the RBI needs to step in. By making loans more expensive, they're gently discouraging all of us from borrowing and spending too much. That cools down the overall demand in the economy, which in turn helps slow down those price hikes.
Another really powerful reason is to manage our currency. See, if the rupee gets too weak, it means we have to pay more for essential things we import, like crude oil. And that affects everything, from your petrol bill to the cost of making, well, almost anything. So by raising interest rates, India suddenly looks like a much more attractive place for foreign investors. They bring in their dollars to invest here, and that inflow of foreign currency helps make our rupees stronger.
You know, the RBI also kind of acts like a guardian for the economy. If money is too cheap to borrow for too long, it can create these dangerous bubbles in places like the stock market or real estate. People and companies can get a little reckless, borrowing too much and pushing prices up to levels that just aren't sustainable. Raising rates is the RBI's way of tapping the brakes and saying, all right, everyone, let's cool things down a bit.
This one's tied closely to inflation. When there's just too much money, or what economists call liquidity, sloshing around in the system, it's all chasing the same amount of goods and services. And what happens? Prices go up. Higher interest rates work like a giant sponge, soaking up some of that excess cash from the economy, which helps bring things back into balance.
So that's why rates go up. But what about the other side of the coin? Let's flip it around and explore why the RBI would ever decide to cut rates, making money cheaper for everyone.
The main reason to cut rates is to give a sluggish economy a much-needed boost. If growth is slow and things feel stagnant, the RBI makes it cheaper to borrow money. This is a huge encouragement for businesses to take out loans, expand, and hire more people. And for consumers like us, it makes buying a new car or a home more affordable. It's like injecting fuel into the economic engine.
A rate cut is also a very direct signal to the banks themselves. When the RBI lowers its rate, it means the bank's own cost of borrowing goes down. This gives them a real incentive to lend more money out, to be a bit more aggressive in offering loans to both businesses and individuals, hoping to get the economy moving again.
Think of rate cuts as a form of economic first aid. During a major crisis, like a global recession or what we saw during the pandemic, a lot of industries are really struggling to survive. Cutting interest rates gives them immediate relief. It lowers the cost of their existing debt, and that can be the absolute lifeline they need to stay afloat and keep people employed.
And just like rate hikes soak up liquidity, rate cuts do the exact opposite. They inject it. By making borrowing cheaper, a whole lot more money is freed up to flow into all parts of the economy. This can give a huge boost to sectors like the stock market, real estate, and manufacturing, encouraging new investments and firing up growth.
Okay, so we've been talking about the big picture, all the macroeconomic stuff, but let's bring it right back home. How does all of this actually affect your bank account? Why should you really care?
This is where it gets personal. When rates go up, your EMIs on home and car loans go up too. Your credit card debt becomes more expensive to carry. But there's a flip side. If you're a saver, the returns you get on your fixed deposits get better. And when rates go down, it's the exact opposite. Borrowing gets cheaper, but your savings don't earn as much. It's a trade-off.
Now, beyond your personal finances, these decisions send massive ripples across the entire stock market, and you'll see that different parts of the market react in very different ways.
So, when the RBI hikes rates, sectors that depend heavily on people taking out loans, like real estate and cars, tend to take a hit. But banking stocks often do well because they can earn more interest on the money they lend out. On the flip side, when the RBI cuts rates, it's usually seen as a positive sign for the whole market. It's especially good for those consumer-driven sectors that really thrive when credit is cheap.
So as you can probably tell by now, the RBI is constantly performing this incredibly delicate balancing act. It's using interest rates as its main lever to try and keep our whole economy on a steady, stable path.
At the end of the day, the core logic is pretty straightforward. These decisions are never random. They are always a calculated response to what's happening. If inflation is high or the market's getting too hot, they'll raise rates. If the economy is slow or needs more investment, they'll cut them.
So, here's the key takeaway. While all the terminology might sound super technical and complicated, it's really all about managing the big economic forces that directly affect your financial life, from the price of groceries to the cost of your dream home.
The next time you see that headline about the RBI changing rates, you won't just see a number. You'll understand the strategy behind it. You'll see a deliberate move to either cool down inflation, boost growth, or stabilize our currency. You'll finally get the why, and trust me, that changes everything.